Joining us with his take on trade at midday is Sam Houlie from Differential Capital. Sam, good to chat to you once again. Now, another bloodbath, if I can put it that way, on the JSE. They'd all share those miners, same as Friday.
Yes, it's been quite brutal since Thursday. Thursday was the start, and I think in the last 3 days, or 2.5 trading days, we've certainly seen a decline, and that makes sense because the commodities and resource stocks are such a big part of the all-share index.
Yeah, I mean, gold and silver plunging as markets digesting Kevin Walsh. What is your take on Kevin Walsh? Do we know who he is? Because the markets are not liking him.
Yeah. Well, he has a long history. I mean, he's been on the Fed. He's one of the governors of the Fed during the global financial crisis, and he's been around a long time. We know quite a bit about him. What's clear is that he's different to the current Fed chairman, and the market has decided that he's very hawkish, which means that he's likely to take the punch bowl away, and he's probably going to try and reduce the Fed balance sheet. For that reason, that's really one part of the sell-off. The one part of the sell-off we think could be that markets have decided, that taking risk on the commodities and any other risk asset is probably not a good idea. But that's not the only reason. There's another reason. Margin requirements on the CME have also changed. So margin requirements relating to commodity speculation, I think, has changed a lot, and that happened to be a coincident indicator. So I think there's a lot more going on that contributes to the sell-off in commodities.
Yeah. Well, they say gravity is back, and that's exactly what's happened there. Let's look a little bit locally. Pepkor, you would have heard now in the bulletin that we just read now. Pepkor solid. I mean, is Pepkor also as well, looking at what's happening with ShopRite, these are both solid stocks.
Yes, both these stocks have very high embedded expectations. Their valuations, certainly in the case of ShopRite, quite high. So let's start with Pepkor. Pepkor, off a very high base, continues to grow. So we like the look of Pepkor. Pepkor has an execution risk in terms of the most recent acquisitions. I mean, the 12 and a bit % of revenue growth is not as high because it's padded a little bit with the acquisitions. And then Ackermans has slowed down a little bit on a like-for-like basis. But the fintech businesses are good and the new acquisitions are doing well. So I would say that the execution risk on the new acquisitions is the key for Pepkor, but we still like Pepkor. It's not as demanding. ShopRite, on the other hand, does have a fundamental issue in that food inflation is lower. Now, lower food inflation is actually good for all South Africans and consumers, good for bond markets, and good generally, but not necessarily as good for ShopRite, which had a phenomenal run for a long time. And the stock is priced quite highly. So I think that the ShopRite management team will have to really work hard to make investing in the stock at this level worth your while. They've done it before, so I wouldn't bet against them, but they do have some headwinds.
Are they coming off the back of a wave that they've been surfing? I'm talking about ShopRite, because they've been doing so well, like you say. Is the wave petering out?
I wouldn't say petering out. I would just say that execution becomes even more important. Their margins have gone up quite a bit. They've really probably grown to a bigger size. It's just common sense says the bigger you are, the tougher it is for you to grow at such high levels. So this is a phenomenal business, probably the greatest success story in the last 25 years in South Africa and Africa. So I would just say that they're almost a victim of their own success, if that makes any sense.
Yeah.
So I think they'll grow well, but if they grow at 4 or 5% and you're paying 17 times earnings, that doesn't make for a phenomenal growth investment. It's a good investment, but you might find other better opportunities. That's really the risk that ShopRite management face.
Sure. All right, let's go back to the US again. Some big earnings. It's earnings season there at the moment. I think even Disney posted their results. What are you looking at the moment?
Well, the one thing that's incredible is that earnings expectations, even though they've been revised, management always revises. They guide to lower so that they can beat. But across the board, the US is beating earning expectations. That's very positive. The US is growing. They're growing faster than most people expect. And the earnings are coming out much higher. So I would expect across the board earnings to be very, very, very strong. It's highly unlikely that we'll have a disappointment on the earnings front across the board in the US.
Yeah. Of course, you've also got the AI stocks as well. The whole big thing of will the bubble break, will the bubble burst? But at the moment, we're not seeing that, Sam. We're seeing them go up and up and up. NVIDIA's a prime example of that.
Yeah, so the way to think about the AI is, so everybody says it's a bubble. And you always have to be careful around these things. So what's clear is that leverage and debt is being funded towards AI and the capex in AI. That really means that it is a growth area, and that's why they're getting the support. It also means that we're probably early days in terms of where that is. I'm not saying that it's over, so you have to be really careful, and the stocks have held up really well, and their earnings will be fine.
Yeah.
I think the opportunities lie outside of that, where the growth, I think, will be much higher, and there are some stocks that have been sold off because people think that AI will eat their lunch, the expression. So we can find many opportunities in the US, and we're not saying AI is bad or a bubble, but we can find opportunities outside of the AI-related stocks.
All right, let's park that bubble now. Sam, where are you hanging your hat today on this lovely Monday?
Well, firstly, I would say that the exciting part of the market has been commodity-related and pro-risk. We can see that's slowing down a little bit, and time will tell. I'm going with an insurance stock, but it's not a traditional insurance stock. My feeling is it's called Fairfax Financial Holdings. It is viewed by the market as a traditional property and casualty insurer, the global equivalent of what we know in South Africa as Santam Insurance. But it is more than that, and the results will come out in 2 weeks' time, and we're surprised. The market has sold off because they think it's a traditional insurer. And they are likely, based on our data that we've looked at and our work, we believe that they will exceed expectations significantly across the board. So we think certainly in the next 2 weeks, the stock will surprise, and it's too cheap at 1.3 times book value, relative to a business that's been around a long time. It's in its 41st year of existence, and it's not a tiny business. So it's one of the better businesses that we've invested in. We've been invested since 2022. We think it will surprise on the upside across the board.
Nice stock pick, nice stock tip as well. Sam, thank you so much. Good to chat to you once again on Business Lunch. That was Sam Houlie from Differential Capital.